Now starting. All attendees are in listen-only mode.
Hello, everyone. This is Chris. It's January the 8th, 2018. I won't be the first, but it'll be the first time that I've got to wish you a happy new year. Hope you had a great holiday, and just want to wish you, the best of health and happiness and prosperity, in the year ahead. And on that third part on the prosperity, we will humbly do everything we can to help out along that side. So let's go ahead and get started today. And just a reminder that, at Kimble Charting Solutions, we want to be your 28-second solution to investment research. It doesn't matter if we have a report that's several pages long. We want you to be able to look at each given idea, and in 28 seconds or less, you can see what the idea is, what action to take, where the stops will be. We're trying to continue to make this as simple as possible. Today I'm going to do just a couple of things, differently, because I do think with the way the market's going on and what I'm hearing, people are trying to overcomplicate, the process. So part of today is just a reminder to try to stay as simple as possible. As I always start off each webinar is we're not a bull or a bear shop. We are bullish on opportunities, even if we would, all that we're trying to look for, everyone is trying to find some asset, regardless of the asset, that moves from the lower left of a chart to the upper right. Whether it's a stock, bond, commodity, even an inverse fund. If an inverse fund is in the lower left of the chart and we like it, we hope it goes to the upper right. So again, we're not trying to wear a bull or bear hat. We're just trying to let price be our friend. And so I just kind of want to remind everybody is what three things does everyone have in common that's watching, this webinar? And in my take, it's death, taxes, and you're judged on how you trade price. Where did you enter it and where did you exit? It's not why you did. It's just where did you enter and where did you exit? No, whether it's one simple reason or you complicated your life and it was a whole series of reasons, it's still, you're judged on that. And you're not judged on how you trade news about our president, how high the PE ratios are, how high margin debt is, how the yield curve is doing, what the Fed's doing with interest rates or going to do with rates, how many pensions are underfunded, how high the federal debt is, or what North Korea is doing. I see all of this stuff in the news, and I think all of this stuff, if you let it get between your 6 inches, which is between your ears, you could overcomplicate, this process. And I just kind of, I beg and I pray that you don't let that stuff get in there and try to overcomplicate this whole process. And this is an interesting piece to me from JP Morgan. It's what the average asset has done, asset classes over the last 20 years. And then the one that sticks out to me is the second one to the right, that the average investor, according to JP Morgan, over the last 20 years has made a whopping 2.3% average annualized return each year. And the key one is inflation is right next to it, is 2.1. So the bottom line is when you subtract inflation from the average investor's return, it's pretty much got nowhere in 20 years. And you didn't even take taxes out of that equation. So we're here to try to help improve your trading, your happiness, your success, your decision-making process, and to try to move away from what that average investor has done over the last 20 years. I think part of the reason the average investor has such a low number is they try to use an investment process that can look like this. It's not a very simple one. And I think that's part of the reason that the average investor has done so poorly, is they just overcomplicate, their world. At Kimble Charting Solutions, we want to be your price shop. And I don't want to try to make it any more than that. We want to be your price shop. We appreciate the opportunity of your membership. We had a fantastic last couple of years. We appreciate, the referrals and different things that we're getting. People signing up for multi-year packages. We're really humbled by that and appreciate it very much. But again, the whole reason that I'm bringing this up is price is the only thing that pays, and that's what we're trying to focus on and try to get all this other noise out of here and just look at where can we buy, where can we try to sell, where are we going to harvest, and where's our risk management point or our stop loss. That's as simple as we're trying to make this whole process. So I want to kind of talk about a couple of things. Should the following be ignored, or should you stick your head in the sand over some of these issues? Shared a couple of these things in the sectors report over the weekend. But this is to me an interesting one. This is there's a mutual fund family called the Ridex funds, They're actually mutual funds. They were the funds that I started using back in 2000 to long and short the market when things started unwinding. This was pre-ETF world. But the reason this is important, or what's the takeaway from here, there's a measurement of the amount of money that is in bull assets in the blue and bear assets in the red. And this is in a ratio that what this would mean is in 2015, and I want you to write down how many times I mentioned 2015 today. So here's number one. So in 2015, there was $13 in bull funds to $1 in bear funds. Then you'll notice that it backed off for some reason. We'll cover that on the next slide, but it went from 13 to 1 in March of 2015, and 11 months later, it was down to 2 to 1. So for some reason, there was a big change. So bear fund assets, people started piling into them, and they started selling their bull fund assets. So that was at points 1 and 2, and we're going to look at where those were on the next chart. But the thing that the takeaway right now, we're at a record level of 20 to 1. That's in the upper right. So we're at a 10-year high in bull fund assets and a 10-year low, and a record high in the ratio of 20 to 1. So this is just a chart looking back a couple of years. And oops, there's 2015. So that's the second time that I've mentioned it. So in 2015, the bull bear asset ratio that we looked at on the prior page was 13 to 1. So what did the asset do when this ratio got really high? Well, at this point in time, it happened to decline 10% in 11 months. And then after 11 months of a decline, it went by, there's the ratio of 2 to 1. So remember on the prior page, it went from 13 to 1 to 2 to 1. So this was an opportunity or an alert or a heads up to risk management. Set your stops tight when this type of thing goes on. You see some negative price action, act accordingly, but don't try to do it until it happens. Let price be your friend. Price is the only thing that pays. Then you'll notice this was an opportunity. See a couple of bullish reversal wicks, and now from 2016, look at this big pop. And again, this is the S&P. The S&P was trading around 1,800, and now it's at 2,700. So now the ratio is at 20 to 1. So this is obviously an outlier, but you can see the last time it happened, the market struggled for a while. Not seeing a negative action here in the upper right, but this is something that I don't think you should trade upon, but you don't want to stick your head in the sand in. So we're going to mention what the American Association of Individual, their sentiment looks like. So on the top is the bull, the percentage of investors at the AAII that are bullish, and the percent that are bearish. So I'm going to highlight a couple of dates. 2011, oops, I'm going to bring up 2015 again. I think that's the third time. And then you see the current spread. So let's look at what did the market do when we saw these large fish mouth spreads in 11, 15, and currently. So in 11, when we saw that big fish mouth spread, you can see that the S&P declined 19% in 6 months, started acting heavy, and a lot of that decline happened in about a 6-week period of time. You saw a series of lower highs. And then in 2015, again, we're mentioning that again, you can see this move down to where it fell 12% in 7 months. So we're seeing some parallels, some things going on. So again, this isn't a reason to take action, but it's a reason to not stick your head in the sand and ignore this. Another piece that I thought was interesting, this is a 30-year look back on the American Association of Individuals Investors, their equity allocations relative to cash. And so you can see in the early 90s, they didn't have much in stocks. And I lived through this. This is my 38th year in the business. I'll celebrate my 38th anniversary in 3 weeks of getting started in this business when I got my first license. But after the '87 crash, this is the time that Saddam and the Iraq War was taking place. There was very little money in stocks compared with cash. Then you can see by the time the roaring 90s, by 1999 rolled around, the number was very high. Then you can see opportunities in 2003, opportunities in 2008 or 9. Then you can see how the ratio is quite lofty again right now. And the only other times it's been close to this high was in the 2000 peak. This is not a reason to sell out, but it is a reason to be aware from a risk management perspective. All of this is about staying with the trend, but also keeping your risk management stops a little tighter than normal because of these conditions. So I've been a subscriber to Sentiment Trader for, I don't know how long, but for years and years. And I love their work, and they are brilliant people. I'll be the first to stand on top of a mountain and say they've forgotten more about statistical analysis than I'll ever know. I love them, and I hope that they are doing well. And I will continue as long as I can fog a mirror. I will be a subscriber to theirs. But let me just talk for a second. There's a difference between sentiment and what are we judged upon? The first slide. We're judged upon price, how you trade price. So here's an example of what their performance was for the year 2017. Their total return was 3.8%. So my point is even being brilliant, if you overlook looking at price and using that as your scorecard, you can end up with results like this that can be frustrating in a year where the market was way up. So again, this could be due to overcomplication of things instead of just keeping it really simple. So one of the things that I think people may have overcomplicated themselves and they missed out on, this past year was the first time in the history of recorded history for the S&P that every month was up for 12 months in a row. Now this is why it's important from a price perspective. So many things have gotten out of whack, and so people, pulled back and missed out on all kinds of trades and opportunities. So again, this is about, let price be your friend so that you can participate in these type of unusual circumstances. Do I know when this streak's going to end? Humbly, folks, that's above my pay grade. Right now I like what's happening. You see our long positions. We're taking positions that are paying off handsomely as far as not only positive returns, but they're providing relative strength compared to the S&P 500. So much of this stuff, folks, it doesn't matter. It doesn't matter. It doesn't matter. And until it matters, just let price tell you when it matters. Someday, some of these things, they're going to matter. It just works that way. But until that takes place, just let it go. Stay with the trend. So some of the trends that I think are really positive as far as from a bullish perspective, in the upper left, I like starting off each webinar when we get into the nuts and bolts is with the advanced decline line. And I'm going to start here, again. This is the advanced decline line on the NYSE in the upper left and the NASDAQ in the lower right. The trends are solidly up. You don't see any flattening right now. You don't see any divergences. The only thing that sticks out to me is the channels are fairly steep from a historical perspective, and each of these are close to the top of their rising channels. Now that doesn't mean they have to peak out, but it would be of notice to me that if these are up here and we started seeing selling pressure, which we're not seeing at this time, that would be something that I'd take a little bit of extra note. But right now, it's going to take a lot to try to derail this very positive train that's taking place. So, but I want to kind of go back and say, why is the advanced decline line important to me? And I put it, every week in the global dashboard, and we're going to follow up with a couple of other things that I put in the global dashboard. But good friend Ryan Dietrich helped me with this. So this is two things. The orange chart is the S&P. We're looking back over 20 years. And the blue is the overall advanced decline line on the NYSE. So the thing that I want you just to be aware of why I bring this up and what you should look for on your own or just be aware of is when you see the market going up and you see a negative divergence. So this was in the late 90s, in 1998, the market struggled some. It didn't really, underneath, it wasn't doing that well. It was a sign of things to come. So this is a negative divergence that you want to watch for. This may be one of the largest negative divergences. I mean, it is the largest negative divergence in the last 20 years. I don't know if we'll ever get one again this big, but I want you to be aware of it. Now, here was a negative divergence in 2007. That was smaller, but the decline in the S&P ended up being the same. This was a 50% decline, and here was a 50% decline roughly. But you see the higher highs, and then you start seeing a divergence. And then the market started, struggling. We started seeing a little bit of some struggle here, a little bit of divergence, and that's where we saw 2015 again. There's that darn year, so that's the fourth or fifth time we brought it up. But you don't see that over here on the right. So this is what I want you to be aware of, why I share this each week, and that right now, despite anybody's even accurate characterizations of valuations in the market, right now the advanced decline line, which to me is, you're lifting up the hood, how's the engine doing? The engine's doing pretty well at this point in time from a bullish perspective. A little bit of just a look back, what happened in the negative divergence in 2000. The top orange line is the S&P, and the black is the NYSE index. And the thing that got my attention, I lived through this. This is when I had my practice. A little bit before this is when Sir John Templeton concerned me when he said, Chris, I have several reasons that I think the market at best will be flat 18 years from now. And as a person that was puking buy and hold at that time, it really got my attention. But as I look back, this was something that what did take place. That you'll notice that from 98 to 2000 down here in the yellow box, the S&P was up 55% in that short time period, but the NYSE was up 30. So here was a lag. The S&P's 500 stocks, as we know. The NYSE's a couple of thousand, 2,500. I'm sorry, I don't know the exact number, but it is broader than the S&P. And you see that you started seeing this divergence taking place, and that was a sign of some things to come. So we saw a divergence in the advanced decline, and we saw a divergence in the NYSE's performance to the S&P. So here's a look over the last 2 years of the S&P versus the NYSE, and you'll notice they're only 5% apart. So on the earlier slide, we looked at the NYSE advanced decline line. We don't see a divergence there, and we don't see a divergence in performance here, which are both positives that help give me confidence to the long positions that I own and the recommendations that I'm sharing with all of you. Here's something that was important from a long-term perspective, looking for divergences. I include this chart, the bottom chart, which is the PIMCO junk bond fund stripped out of dividends, looking totally at the NAV. One of the reasons I like this is that fund is how far its track record goes, because you can go clear back into the 1990s on this. But you'll notice that junk bonds, just like the advanced decline line, started showing a negative divergence in 98. And see, here's the market's moving up, junk bonds are heading down. So that was a negative divergence, and we know what happened after that. Here's 2007, we see a negative divergence. Junk bonds are starting to head south. The market barely up to flat. That's a small negative divergence. We know what happened after that. Oops, here's 2015 again. We see a negative divergence, and then we see the S&P heading up, and then we saw the sloppy action. So we're seeing a small negative divergence again in junk. Not huge, but it has been taking place for several months. So this has my attention. This is not a reason to sell, not a reason to panic, but this is something to keep on the radar screen. So I do report this every week in the global dashboard, but I kind of wanted to go backwards and show you why this is important to me. Here's another piece that's important to me. The top chart's the S&P 500. The bottom is the equal weighted divided by the cap weighted S&P 500. So the ratio is the RSP divided by SPY. So the S&P itself is cap weighted. The number one stock has a lot more influence than the 500 stock. But when you look at RSP, the number one stock is no different as far as its influence to the performance of the index than number 500. So in 2007, we saw a negative divergence in the ratio. See how the S&P was still heading up. We saw a negative divergence. We know what happened then. But positive divergences also happen, everyone. So I want you to keep in mind of that. So you can see here was a real positive divergence that in the bottom in 2009, we saw higher lows versus lower lows in actually the index. So that was a really positive sign of things to come as far as the market heading higher. So whoops, here's 2015 again. That's number 5 or 6. We saw a negative divergence taking place. Saw the market peel off some. So this is then one of the larger negative divergences that we've seen in this ratio to the S&P, as the RSP-SPY ratio has been heading south for a year while the market's been heading up. Now, again, this is why price is the only thing that pays. I'm not going to stick my head in the sand on this, and I'm not going to hide it. But what is the main thing right now, folks, is the upper chart. Prices are still going up, and we're seeing assets that are heading higher. But I don't think this is something that we can overlook. But you don't want to let this be your major influence to decision making. But sometime I suspect this will matter. And it's going to matter in one of two ways. If it breaks support and heads south, imagine that'll send a more concerning message to the market. If it would break higher here and break 1 year falling resistance, that'd be really a positive situation for the market. So again, this is something that I share every week in the global dashboard. I wanted to back out and show you a much longer term view and share why this ratio is shared each week and why it's important. So another thing that I share each week is where we apply Fibonacci levels to the 2007, and this is a monthly closing high. So keyword is closing high and closing low of 2007 and 9. Now, we share this regularly each week, and the 161 level came into play, and you'll notice that as the market ran up, it spent 21 months failing to get above this line. Now, as we look back in the rearview mirror, what was it doing? It was building an upper level base right below this Fibonacci 161 extension level. And then you can see it pushed above it, then used old resistance as new support, and it was off to the races. And then a huge percentage increase, because that was what? Dow 18,000 to 25,000. Once the breakout, old resistance test to support, and then it's one of the more vertical moves that we've seen since the 2009 lows. So the reason I want to bring that up is continuing to update. So this is the same chart again, the Dow monthly, closing prices again, 2007 and 9. Here was this base that spent 21 months, and then here's the test of old resistance as new support, and it's skyrocketed up. So each week, this is in the global dashboard as well, and we started sharing this over a year ago that the target was 25,000 on the Dow, and the Dow's there. And so it's, you know, when it comes to these big numbers, it's interesting to me that back in the early days, when I got started in this business, the Dow was below 1,000. And if the Dow moved 40 points, it was a great day, because that was 3 to 4% in a day. Now it'd be amazing if the Dow would move up 4%, it'd be 1,000-point gain. So sometimes it's always amazing to me how some of these numbers work. But we're at that point. But I'm going to now do this chart just a tad bit different, because I've been mentioning that I've been sharing each time that this is on a closing basis. But what if we did the same Fibonacci on a high-low close? So this is the same chart, the Dow monthly, but we applied the Fibonacci to the high of the monthly move, intra-month move, and the low. So here's the bullish reversal wick and the bearish doji star bearish wick right here. And so that 261 extended level comes out to be 26,758, or let's just call it 26.7. So if you look on the right, that's about, what, 1,500 points above the current levels. But it's amazing to me, 1,000 points is just 4%. So we're not that far from this level, but that will be another level that we want to pay attention to, that if we started seeing some weakness in the markets, that's where it could struggle a while, just like it did against the 161 level. So I've started off sharing in both the global dashboards and the sectors report with the semiconductors, because as I've tried to share, these are really upside. This is an upside leadership index. And I will be the first to admit that upside leadership can change. So this isn't biblical or the holy grail, but this is an index to me that it's the guts of the computer era that we live in. And what has my attention is, you know, the 2000 highs in the semiconductor after the index went from 110, you know, roughly to around 14, so over a 90% decline. Now it's went up by 900%. So now it's back at 2000 levels. So this is a monthly chart of semiconductors on the left, a weekly chart just looking closer on the right. So here's the high that took place. So here was the 2000 level, and this is also this horizontal line's at 2000 level. You can see it hit the top of the rising channel 1 and the 2000 highs right here. It peeled off for what, 1, 2, 3 weeks right in here. Spent almost 3 more weeks here, and then its support held. We saw a heck of a rally last week, and this is just a Tuesday. But you can see as of Tuesday's price action, we see a little bit of a bearish reversal. So for bullish positions or a bullish case, the price action that you'd want to see is a semiconductor taking out that 106 level, which was the highs back in 2000 and the highs of back in December. You would get a concerning message if you would see this channel support break. So the trend remains solidly up. Support has held. You see a good rally off of that. But I'm going to continue to share the semiconductor index for both cases. We'll share if there's a bullish breakout, which will send good news to the tech sector. And if we would see a breakdown, a rising channel 1, we're also going to update that because that would be a cautionary message to the tech sector itself. So moving from stocks to interest rates, I want to share, I did a quiz on the blog today. So if any of you happen to see the quiz, it's this chart. So as members, here's your answer. But this is a 25-year look at the yield on the 10-year note, the U.S. government note. And you'll notice that it stayed within falling channel 1 very uniformly for the past 25 years. About a year ago, we saw this sharp rally from mid-2016, and it ran up and came right up to the underneath side of channel 1, made us a short-term double top right here, and then rates backed off. And now it's making a push higher. So I didn't put it in here, everyone, but if you could imagine taking this falling channel line and just making a parallel one and coming down here, there's a chance this is a bull flag pattern. Bull flags are a continuation pattern to the upside, but you can see this week, and obviously we're just early in the week, but we see an attempt to break out above the 25-year channel resistance. So to me, the big test for interest rates comes into play at this green horizontal line, which is at the roughly the 261 level in the 10-year yield. So if we would see, there's been the debate, there's been debate for a long time. When's the 20-year decline in interest rates going to end? Now's the time. Whoops. Now's the time that the 25-year trend in rates is going to. We've heard, the demise of bonds and the demise of falling interest rates for a long time. Hasn't happened, but this even guy Rick Santelli on CNBC that I admire enormously, he said the tombstone is up for the death of the bond bull market. He said that earlier today. It's above my pay grade, folks. I'm not making some giant call on anything like that, just not smart enough to know. But if we see a breakout above 261, that could see interest rates, start pushing towards, the 3% level as far as its next overhead resistance. So a big attempt on rates to do something that it hasn't succeeded in 25 years, with the big test being at 261. So what would we do if this would be true, that rates are breaking out? Well, here's the thing that I really think that we should watch is, let's just watch an inverse bond fund. So this is TBF. This is the 1X inverse bond fund to TLT. So the TLT is the 20-year very popular long bond ETF. This is the opposite, TBF. If you're really convinced, or whatever you want to lever up, the chart to watch would be TBT. That's the 2X inverse. But right now, TBF remains in a long-term downtrend, no different than yields. You can see the falling channel resistance line. So I would be interested in buying TBF if we see a breakout. So we see 10-year yields attempting to break out. I'm going to use this as my barometer, not to say that the 30-year bond bull market is over, but from let price be your friend. If we see a breakout here, I would be open to buying TBF. Hasn't happened yet, but keeping it on the radar. Another thing that's interest rate sensitive historically, historical correlations can always change, but oftentimes utilities like falling rates and they get concerned about rising rates. So this is a look at XLU, which is the utilities ETF, and we're looking back 18 years, so it's a pretty decent look back. So there's two parts to this chart. The top part's just the price of XLU. The bottom part is a 6-week performance. And so I'm just going to start with that. You can see that XLU has declined almost 8% over the last 6 weeks. It's now reaching kind of some of the lower level. You can see that not too many times in a 6-week period over the last 8 years has it declined much more than 8%. So this is a big test for its short-term decline. But to me, the bigger test is there's not many indices that are out there that if you take the 2009 low and you start finding support, that support is being tested as of right now. And it is an XLU. So a couple of takeaways right now. Support at number 2 is support until broken. If number 2 would break and the historical correlation of utilities don't like rising rates, this could actually be a confirming tool to say we've got something different on our hands interest rate wise. And it would give some confidence if TBF, which is the 1X inverse ETF, if it would break resistance and XLU would break support. So you could have a couple of ways to play this. If the interest rate world is actually changing, you could buy TBF, short XLU, or both. So, but I wanted to update you. This is a big 8-year test for partially in the theme of are rates going to rise, or not. So I wanted to kind of talk about falling out of favor and what if some of the interest rate trend would change, what might fall in favor. So as you probably just backed up and said, whoa, what's this about? This is a great chart looking at several different asset classes performance. This is from JP Morgan over the last 14 years. And so it shows, like as an example, just pick on emerging markets. You can see it's in the purple. You can see how emerging markets did pretty well here. And then, so they did well from 2003 to 7, and then where'd they go? Well, let's see. They went down here to the bottom. So they lost half their value in 2008. Then they responded up 80%. So the point that I want to share this is that, you look at small caps, you can see that they can be close to the top, and then all of a sudden they can be down here to the bottom for a while, and they can be close to the top. So it's not uncommon to see rotation of assets rotate from high performance to low. When stocks were doing well, look how bonds did. They did really poor, and then all of a sudden bonds went from poor to middle of the road to top of the pack. Well, that was when stocks were struggling. And then in 2009, when some of the things started rebounding, by the end of that year, you see what bonds were back down at the bottom again. So the takeaway to me here is what I put in the red boxes. Not too many times are we seeing, we see REITs up here. That's a common theme that would probably say, well, maybe REITs have had a pretty good heyday for quite a while because 1, 2, 3, 4, 5, 6, 5 out of 6 years they were number 1. Pretty impressive. But the thing that gets me is now 1, 2, 3, 4, 5, 6, 7 out of 7 years, commodities are pretty much at the bottom of the tank. And so someday, I don't know if it's the day, but someday this could change. And, what if, I always used to say, what if my parents had made them sick? I might apologize if I make you sick on this, but what if interest rates are heading higher? And what if they're heading higher for an inflationary case, or that the world's growing and that the world hadn't grown a lot for a long time? Just, what if some really good things are going on? if some of those good things are going on, maybe this could shift from down here. So I don't know that this is going to go on. I'm not into macro themes. You don't see me getting on my soapbox and just banging the macro themes a lot. I'm not going to here, but I'm just kind of wanting to make you aware of some shifts that may be changing. Maybe interest rates are changing. Price is going to be the only thing that pays there for me. So I'm letting you aware of where important prices may be. But if commodities would tick up, let's just kind of look at them for a minute. So several of you that are going to view this have been very long-term members, and I'm really humbled of the long-term membership, in Kimble charting. But in 2014, we shared this chart, and this is the Thomson Reuters Equal Weight Commodity Index. And we shared that in 2014, as I looked back, cheating, you could look back on every asset there was. This was the largest potential head and shoulders topping pattern in the rear view mirror in 2014 that I could find of any asset over the last 100 years. Now, it didn't mean that my read was going to be correct, but at that time, it just looked like this is a mother of all topping patterns. And, again, folks, this is a 40-year chart. This looked like this could be a neckline. So we started beating that drum in the summer of 2014 that if this read is correct, these puppies are going to struggle. Don't get yourself overweighted in commodities. Potentially, if you're aggressive, be open to shorting them. And then you can see what happened. So commodities declined for several years. That's what we saw on the prior page. They stunk it up for several years. But you'll notice they came down and hit this neckline in 2016. Stocks started heading higher. Commodities overall, seem to have bottomed at that time. Some metals, this was a decent low point for some of them. So I want to update, just from a 40-year perspective of what this pattern looks like. But you see kind of some choppy action, here. So let's look at this chart just a little differently. This is the exact same chart, but a little closer. Here was the potential head and shoulders top. But just looking at what's been happening, here's the neckline. We saw a rally off the neckline to a year ago. And this is just the 23% Fibonacci retracement level of the 2011 high to 2016 low in commodities. So you can see that if commodities would happen to do well, they really haven't gone anywhere yet. They haven't even got past their smallest Fibonacci retracement level of the whole decline. But they've struggled there. There was two highs right at that level. So now we also see falling resistance. So I see, so far, an 800-pound gorilla above. But I also see higher lows that's forming a pennant pattern. So if commodities would happen to find some strength and break out above this top falling resistance line and above the highs of 2016 here at the 23% fib level, that would be a positive signal for commodities. And maybe these things that have been so darn out of favor, stinking it up for 6 of the last 7 years at the bottom 2 asset relative performance pieces, maybe something changes. So I'm not going to say that it has to. Right now, they're still in a downtrend, and they haven't proven anything other than you want to avoid them a bunch, and we have. But there's two charts that if this happens to be, if a breakout would take place, where are a couple of charts that have some attention to me. The first one would be gold. This is, again, a 38-year chart, almost 40 years of gold on a monthly basis. Gold took off in 2001, had 12 years in a row higher until it peaked in 2011. But there's what has my attention here is gold still remains above this long-term support line going back to 2000. So this would be roughly a 17-year rising support line. And there's a potential that over the last few years, it's been creating a bullish inverse head and shoulders pattern. So whether that read is correct, throw it out the window. We do have two things in common, or at hand. A rising support line that's pinching up against a horizontal resistance line. That's frustrating both bulls and bears because gold is not going very far. But someday this narrowing pattern, which could be a bullish ascending triangle right in here, if we see a breakout, it's very bullish. So I would If we get a couple of other things that we see in the metals report acting better, but what if interest rates head higher? We talked earlier. What if commodities would finally respond? But just from a price perspective, if gold would break out, that'd be rather bullish. And if gold, for whatever reason, breaks this 18-year support line, that would be rather bearish. So I'm going to let price determine all of this. No macro stuff, but this is just a pattern that really has me interested from a very long-term price perspective. Another commodity that's sometimes important to the world, crude oil. Crude oil since 2000, 14, where it peaked above 100, went down into the 20s. There's potential. This decline that has spent the last couple of years itself making an inverse bullish head and shoulders pattern. Whether it's making that pattern or not, it is testing a really critical level this week at the 62 level, which was the 2015 highs. This is where it ran out of gas in 2015. So now it's kissing the underside of resistance here. So another big test in the commodities market here for one of the most important commodities in the world. If we would see a breakout, it'd be a positive for this asset because it could sure run a while after this meltdown, that it had. So again, a couple of potential long-term bottoming patterns in gold and crude. So it'll be really interesting as we have this webinar a year from now where those two will be. Believe you can, and you're halfway there. Well, it's taken a lot of time to get to the halfway there point. So this is Japan, the Nikkei index, a long-term 30-year chart on a monthly basis again. Here's the high in 89, around the 40,000 level. Here's the low in 2009. So it fell, 20 years from 40,000 to 7,000, losing roughly 70% of its value. And then it's made a series of higher lows inside this green rising channel. And the difference in these two shades right here is I applied Fibonacci to 89 highs and to 2009 highs. And this difference in color right here between the pink at this line is the 50% level at roughly 23,200. So this index is making an attempt to push higher. And it could be breaking above that 50% level. And you'll notice that in 1997, it struggled with that. So if it could break above the 96 highs, 96 high, above the 50% level, this index that is still so far from its all-time high, the S&P, almost every major index in the United States, where is it? All-time highs. But this thing is still, close to 45% below its all-time high. So maybe there's a game of catch-up to go on. So positive breakout here, very positive price action if that continues. So a couple of stocks that, oftentimes when rates rise in the States, banks do better because their margins expand. So oftentimes if rates do rise, you want to think about the bank holdings. And, as far as a premium member, we still have, we have a couple of different bank holdings, in the portfolio. So we see positive price action going on. But here's a couple of banks in Japan that have, or related in the banking or financial industry that the patterns really have my interest. So this is a weekly chart, but you can see from 2009, so for 9 years, Mitsubishi Financial, the symbol's MTU, has essentially went nowhere. It's stayed between these two blue bands. It's back at 2015 highs right now. So if we would see, regardless of any macro pictures, any interest rate thoughts, any commodity stuff, if MTU breaks out here, I'm interested in owning it. And so there's a big test going on. So I've got buy alerts set on this one. And another one is Nomura Holdings, which is NMR, which, what if over the last 9 years is creating a monster long-term bottoming pattern, inverse head and shoulders. Whether this is a neckline, whether this reads correct, this is a resistance line that's in play. And if it would break out at 1, it could sure attract some buyers. There's a potential this is a bull flag taking place, right in here. So I've got another buy alert to NMR. If it breaks out, I'm interested, in owning it. So I appreciate your time today. I wanted to just do some things a little bit differently, not look at a lot of positions, just look at a lot of indicators. As I've heard from, you just see it on the street, and a lot of, whether it's in the social, realm, it's easy to find people that have disliked this market and are bearish in different things. And, the main pattern theme that we've liked and taken advantage of this past year is the ascending triangle pattern, which is, what is that? Think about it for a second. It's a series of flat tops and rising bottoms. Had a good email from a premium member. He said, Chris, seems like sometimes you buy some stuff that seems extended, but it's up against the top of this ascending triangle pattern, and lo and behold, boom, it breaks out and it really pays off for us. So that's, one of my continued, and not just mine, it's one of the most positive patterns that can take place in a constant, in a rising bull market. It's the pattern to take advantage of, and that's what we've tried to do. We've also had some real good success, buying some stuff that's, been beat up. But today, again, was to just as a reminder, I pray and hope and wish, for, again, your health, happiness, and prosperity, and that you try to keep this world. It's easy to get overcomplicated. And I want to try to keep things as simple as possible. As a reminder, we started off this thing, price is the only thing that pays. Death, taxes, and we're judged on how we trade price. We appreciate that we're a price shop, and that you're a member of our price shop. We are humbled and very just honored by your membership. And so we look forward to another good year. Again, this is going into my 38th year, turned 60 this past year, and I still never found this business any more exciting than I do now. And so I pray to just continue to be able to fog a mirror and have fun doing this, and I hope that all of you, do too. So again, as far as your membership, I'm trying to stay in touch with most of you each day through different either raising stops in this market or whatever. But I look forward to visiting with you again next month on the first Tuesday of February. Thanks again, everybody, and all the best to you.